It's 4 p.m. here at DBS Asia Central. I'm Taimur Baig, Chief Economist at DBS Group Research. With me is Senior Economist Ma Tieying. Hi, Tieying.
Hi, Taimur.
How are you doing?
I'm good.
Good. Tieying just got back from Taiwan, and hence today's presentation, after I'm done covering some of the global aspects, Tieying will take over and talk about her views not just on Taiwan, but also on Korea and Japan. 50-50 presentation along with Q&A. As you can see on this slide that we have on the screen right now, you can either scan the QR code or go to dbs.pigeonhole.at and type the passcode macro, and that will take you to the question and answer session, and you can feel free to ask any questions you want. I've already sort of outlined the presentation for today, which is first half, I will talk about the global economic outlook. Tieying will talk about the Japan, Korea, Taiwan part. And so let's just get going. On the issue of global economic outlook, the US economy is ending the year on a very strong note. When we look at the nowcasting information that's coming out of Atlanta Fed, the tracking right now is close to 4% on an annualized basis. So the government shutdown, all the uncertainty around China, US. You may remember a couple of months ago, Trump had ratcheted up his rhetoric. Then, of course, he ratcheted back down. But the fear that we had during the course of this year is that this huge amount of volatility on trade coming from the US, hot, cold, high tariff one day, deal the next day, that this would have a very debilitating impact on investment and consumption behavior has actually not quite borne out. As you can see in the US, when we look at the drivers of economic growth, various data points that go into the nowcasting include retail sales and what's happening with construction, what's happening with manufacturing and output and so on, and trade, of course. All of those seem to point out to an economy that actually withstood most of the Trump-related volatility pretty well. It was very poor for a little while in April, and since then things have been just about rosy. When you look at retail sales, for example, on the same slide, right-hand side panel, you'll see that retail sales this year, since summer, has sort of been on a very strong uptrend, growing at about between 5 and 7.5% on an annualized basis, which, by historical standards, is very strong in the US. You're talking about the largest consumer market in the world, and that market growing by 5-7% is great news for global producers everywhere, because the Americans, despite all the trade tariff related difficulties, are voracious importer products, and they're going into the holiday season, clearly have not scaled back their consumption. All sorts of negative news in the papers. Sentiment markers in many surveys show American consumers are fairly pessimistic. But when it comes to the actual behavior of reaching into their pocketbook and procuring products, it's going pretty well. So first takeaway from our year-ending presentation is that the US will end 2025 on a very strong note. Our GDP forecast for the US for 2025 was 1.9%. I have a feeling we're going to be wrong. It will be higher than that. So US will probably end the year maybe even at a 2.25 or 2.5% growth, especially what the Atlanta Fed nowcasting is suggesting for both Q3 and early Q4. When we talk about sources of strength, I showed you what's happening with consumers, but even if you look at what the purchasing manager surveys in the US are suggesting to us, what I have on the screen right now are only the manufacturers, two different surveys, the ISM survey as well as market manufacturing survey. Both are showing pretty decent numbers, particularly with respect to the market manufacturing survey. We're talking about robust expansionary territory and expanding, as in the first derivative itself is positive. Momentum is good for manufacturers going into the final quarter of 2025. In the case of the ISM manufacturing, not as rosy, but again, no major sign of deceleration or contraction beyond what have been the number for most of this year. When we look at non-manufacturers in terms of services, both market and ISM show firmly expansionary territory. Again, market looks really, really good. So this is a bit of a contrast between the earlier readings that we saw. that again, both are in expansionary territory, and the ISM one, the non-manufacturing, is actually expanding going into October of this year. So ISM manufacturing, some contraction, ISM non-manufacturing, firm expansionary territory, looking very, very good. What about labor market? That's where the big concern is, that AI-related disruption, trade-related uncertainty, all those things will start feeding into weak data on hiring and wages side. Well, on the wages, yeah, there is something to it. As you can see, wages are now growing at about 3.8% on a year-on-year basis. U.S. is a big, complex economy. Wages, on an aggregate basis, doesn't tell you the whole story. You got to really look at sector by sector. But just in general, to talk about overall labor market health, what we're seeing is inflation of around 3%, real wage growth at sub 4, so not particularly strong growth in real income. And considering what we had a year ago or so, well over 4%, that is not necessarily the greatest reading. As far as unemployment is concerned, the unemployment rate has begun to tick up. We used to deal with 4.1 or so earlier. Now we're firmly in the mid 4.4 range. Variety of factors involved there beyond the white-collar job recession. You probably have some dynamic related to the labor force size itself changing because of all the immigration-related crackdown that's going on in the U.S. And the number of vacancies has come down. But overall, if you have decent skills, it's not like you're going around not finding jobs. What is, however, happening is the overall health of the labor market beyond the aggregate number or the average number of unemployment rate or wage rate. That doesn't look that great, especially if you compare it to the Biden years or even Trump 1.0. Let's look at that in some greater detail. So what we have on this slide is Trump 1.0, 2016 to 19, the breakdown in private and public sector job creation. Then we have the Biden year. I am not going to include 2020. That makes no sense. That was the COVID pandemic. Things were really, really sort of discordant at that point. So 21 to 24, which of course includes some of the post-pandemic rebound. So they look really, really good, and Biden's performance looks exceptionally rosy. But regardless of what drove those outcomes, if you look at this year, 2025 so far, that outturn is significantly weaker compared to anything that we have seen in the past 8 years. 168,000 jobs on average being created during Trump 1.0 on the private sector side. That number was dwarfed by the 300,000 plus created under the Biden days. Compared to all of that, just 72,000 or slightly below that so far this year. Public sector employment during the Biden years was very robust, almost 40,000 a month, significant expansion of public outlays in those days. Even under Trump 1.0, it wasn't that bad, 13,000 a month. But this year, of course, Trump came with Doge and Elon Musk and all sorts of disruption to Department of Health and Department of State and so on. And now you're beginning to see the impact of that, largely negative, which is that barely any public sector jobs created, only about 4,000 a month. That, of course, weighs in, especially if the economy was used to 40,000 a month being created during the Biden years. It is a big climb down. Perhaps people made a lot of money in the preceding years. Perhaps this year's stock market return has still boosted people's portfolios. And therefore, when we talk about consumption, we don't see a reflection of this labor market data, the weakening labor market data on consumption. But it is nonetheless a big source of concern for the Fed going on to 2026. And whatever dovish signal that they give, it would be coming from here. It would not obviously come from inflation because there are no major signs of deceleration in prices in the US. It'll be the big issue to talk about in 2026. But for the time being, the Fed will sort of ignore the inflation stuff, focus on charts like this, and justify further rate cuts along these dimensions. Now, speaking of the Fed and speaking of 2026, what will the market do on the fixed income side as far as the yield curve is concerned? What you see here is that there's been a substantial downshift of the yield curve of the U.S. Through the course of this year. The red line, both end 2024 as well as the spot, shows you that there's been about across the board 50 basis points shift downward of the yield curve. Perhaps we might see a little more at the end of this year, especially if on December 10th, the Fed goes ahead and cuts and gives slightly dovish signals of more cuts to come in early 2026. All of that is interesting on their own. I will show you some charts later showing that just because rates have come down, the yield curve has shifted, doesn't necessarily mean that the liquidity situation has improved materially. We'll talk about that momentarily. Let's just leave the US aside for a second and just look at the bottom part of the chart, which looks at the yield curve behavior of Singapore govies. That's really interesting. It has shifted down way more than the US, and especially at the short end, but also at the long end, much more exaggerated shifting downward. So what explains that? Are there some global cues or are there like local cues? My view is that shifting down is a global cue, but shifting much more so than the US is a local cue. Singapore has massive capital inflows, massive FDI flows taking place right now. I always like to call it that the region is going through a golden age of investment, particularly in technology and technology adjacent sectors. In addition to the flows, there is absolutely no inflation risk to talk about. So inflation risks dissipated, massive amount of flows coming in, and perhaps the economic rebound, although we will probably end 2025 with about 4% growth in Singapore, it's still, I think with 2026 in mind and trade in mind, is not necessarily creating a massive credit cycle where loan demand is fully absorbing all these inflows. No, there's actually excess liquidity in Singapore, and hence the curve has shifted down so much. I personally think, and I think our senior rate strategist Eugene Liao agrees with me, that as far as the Singapore curves are concerned, I think we have seen just about all the rally that we can see. If anything, there might be some risk of the rates to rebound in that context. All right, let's come back to the US because that's what our focus was in terms of talking about global cues. US yield curve has shifted down. If indeed the Fed heads back into QE territory, we might see the long end rally some more, but there are some countervailing issues. I will talk about the risks in a second. All right, so Fed narrative for 2026. Lots to consider, but before I talk about the words I have on the screen, let's focus on the chart I have on the screen. What you see in this chart is our marker for liquidity, so which is the gap between US repo rate and effective Fed funds rate. And as you can see, it has started to creep up, not like in an alarming manner or anything. There tends to be, a pretty well-behaved series with a few spikes here and there notwithstanding, but it has moved up a bit in the last year or so. We basically had banks lending to each other more or less at the Fed effective funds rate earlier. Not so much the case, as gap is about 25 basis points and perhaps showing some tendency of rising. It is taking place at a time when the repo rate has come down a bit, but not as much as the Fed's fund rate. So that's the issue. That's why the spread has picked up. That the repo rates, the rate that the banks charge to each other, has followed only partially the accommodation that the Fed has displayed. Now, this is a crucial marker to track going into 2026. As we said earlier, we expect the Fed to remain dovish and cut rates more. Would that achieve the objective of easing monetary conditions, or would the Fed have to resort to a quantitative easing type framework to bring back no difference between repo rates and effective Fed funds rate type situation? So far, given the fact that things have turned up a bit, not quite sure whether the Fed needs to do something or not yet. I think first thing that we need to watch as of this week, the Fed is going to stop doing quantitative tightening. Whether that alone has the desired impact. If it doesn't, my view is by the first quarter of next year, maybe stepping into the second quarter as the successor of Fed Chair Powell comes in, likely Mr. Hassett. We'll see about that, whether Kevin Hassett gets the job or not. We'll probably know in a few weeks' time. And then would the Fed then be able to bring down the spread that we have between the repo rate and the effective Fed funds rate? All right, so 5 things to consider, and those are the bullets that I have on the screen. What is the neutral rate for the Fed officials to consider when they make forecasts of inflation, when they make forecasts of the terminal Fed funds rate, if they believe that the US is now sort of stuck at 3% inflation for the time being, 2025 for sure, more and more looks like it'll be in 2026 as well, then perhaps you can't have a Fed funds rate going below 3%. If that is the case, then there's not much left in this rate cut cycle. So that's key issue, unless you have a Fed governor who comes and who believes that Trump has ordered him to keep Fed funds rate low very, very stridently, and he'll keep cutting, and that would then cause other issues. For example, liquidity. If you keep cutting, but the Fed repo rate and the EFFR starts to widen, how do you then do liquidity operations? Rate cut alone would not be sufficient. You might have to resort to QE, going back to our earlier point. Then this issue of fiscal dominance. What if the US growth, which is tracking at close to 4% now, remains very robust? What if inflation heads above 3% next year on the back of strong demand and perhaps the AI boom causing electricity prices to go up and other things to go up? Well, what would the Fed do at that point? But my view is the Fed would not be able to do much in terms of turning hawkish because of fiscal dominance. Fiscal dominance is the idea that when you have the central government saddled with massive amount of debt, it is incumbent upon itself to see an interest rate environment that is lower than what might be warranted by fundamentals, because the fiscal pressure itself is so big that the Fed would have no other resort but to remain on the dovish side, even if that means erosion of Fed credibility, even if that means inflation expectations ratcheting up. That is the risk you run when you have very, very large deficits and debt, which is the situation in the US. Perhaps, if indeed things become that bad, maybe the Fed would have to resort to doing rather heterodox measures, and measures that not only just heterodox, but something that used to be in the domain of emerging market economies. Financial repression is what I have in mind, meaning yield curve targeting or yield curve cap, interest rate cap, or some degree of regulatory measures to make the whole banks and financial system hold more US Treasuries, things like that. You would sort of have the US succeed in capping yields at that point. That would then manifest into significant sort of bearish sentiment on the dollar or US corporate credit and things like that. There is no free lunch, but the Treasury may be compelled to go down this road simply because there is just so much debt and they just can't afford a blow up in interest rates to deal with that debt. Additionally, although you could say that from financial repression you could go to financial stability issues, I'm not making that linkage in the short term. For me, the short-term risk has nothing to do with the inflation targeting or lack thereof of the Fed. It is more to do with the fact that the Trump administration is nudging US financial authorities to reduce regulation in a very big way. Reducing regulation sometimes sounds good. You have less red tape and less friction, and the system can operate more efficiently. But as we have seen in the case of the US financial system over the last quarter of a century, that the system is prone to boom-bust cycles, system is prone to all sorts of failures on the market side. Without a strong regulatory framework, these issues will come to the fore again and again. So the Trump administration's sort of light touch approach with respect to how banks operate, how non-bank financial institutions operate, how cryptos are traded, how stable coins are traded, makes me worried. You will not find many regulators out in the world very comfortable with the direction of the Trump administration there, because they worry that this would have an impact on financial stability. So that's the thing to watch out for in 2026. Near-term risks, with 26 in mind, three things. One is this whole AI bubble question. Do we have a massive bubble in the AI system? Are the NVIDIAs of the world basically doing circular deals with OpenAI and Oracle, and they're all sort of feeding off of each other? What if we don't come up with a killer app for AI usage in 2026, and market begins to question whether all these hundreds of billions, if not trillions of dollars of investment that's going into AI would be justified, and would there be, if there is no commensurate revenue pickup around that? If that were to be the case, we would have a big problem as far as the equity market is concerned. And given how big the US equity market has become, and given how big AI stocks are part of that US equity market performance, the downside could be rather problematic, and the contagion for the entire global financial system could be quite substantial, because we are all, just like we were in 2007, we are all exposed to the US AI market, given our exposure to US equities, given the lending that has taken place from this part of the world into the US in AI-related infrastructure. Second is this crypto sell-off that's been taking place over the last few weeks or so, I'm not necessarily that concerned about crypto sell-off. I'm interested in what it says to us in terms of market sentiment. For crypto to sell off in 2025 is unusual because just like I was talking about light touch regulatory approach by the Trump administration, I mean, there hasn't been any administration in the history of the United States that's so enthusiastically backing alternative arrangements beyond the US dollar. So this Trump administration is clearly a crypto administration. You see Trump family involved very much into crypto-related transactions. So much cheerleading going on by the White House, and still we have seen a good 20-30% sell-off in cryptos. So risk of sentiment is sort of setting in the market for speculative assets, crypto being the number one in that area these days. So I think it sort of behooves one to sort of keep an eye on this thing. Oh, but before I go into the geopolitics, I just wanted to talk about the chart that's also on the screen. The AI bubble part is something that we can debate ad infinitum. If you're a crypto optimist, you will say that all this build out is fully justified given the amount of demand that there is for it. But when you look at just the valuation metric, put aside all AI related questions, just look at the US stock market at face value. That one of the key valuation metric is what is the dividend yield coming from the stocks and how much of a spread do you get when you look at the safe rate of return. And as you can see, the US Treasury yield minus S&P 500 yield, that gap has again gone back to basically where it was back in 2007. We all know what happened to the stock market after that. I'm not saying what happened after that by saying that I'm predicting a crash. I'm just saying that it is going to be hard for the market to rally any further given that kind of valuation. Either you have a big decline in interest rates or you have a big pickup in dividends. Something has got to give. We'll see where we go with that. Finally, on the Trump and geopolitics side, we have sort of breathed a sigh of relief in the last few months. A lot of carve-outs, a lot of exemptions on semiconductors, on pharmaceuticals, all sorts of quote-unquote deals have been signed between the US and Korea and Japan, and some understanding with China, some pending stuff with India, which probably will come in the next few months. Are we out of the woods as far as trade weaponization is concerned? Absolutely not. I would not put it beyond Trump administration to bring back issues related to trade over and over again. This is as core idea as it gets as far as Donald Trump is concerned. So I would still worry about geopolitical noise in 2026 and trade being weaponized again and again. So that issue is not going to fade at all. So that's the view. I just want to end with one sort of positive note, which is that Asia, having been stress tested this year, is ending on a very strong note. Look at the PMI of Asian manufacturers all the way through October of this year. It is now firmly, on expansionary territory, given back all the losses that we saw after the reciprocal tariffs were announced. Exports have been robust. Even if you see the last dot, which shows that some of the front loading of exports related sugar rush is coming to an end, and exports may not be growing as robustly on a year-on-year basis. But the fact is, exporters are now feeling the best that they have felt in a year. That is remarkable given the way this year started. Now, this is a picture that you're seeing is all of Asia, GDP weighted for exports and PMI. Let's narrow it down a bit and just look at ASEAN. It's an even better picture. ASEAN PMIs are now, again, all the way through October, are even better than they were a year ago. So we're now at a 2-year best reading. This chart only extends back to October 2023. And it's not just the sentiment. Exports are at a 2-year high. So ending the year on a very, very positive note. It's a big nod to Asia's resilience. Despite all the noise from the US, despite all the difficulties of dealing with China, Asia is balancing US and China very well. And Asia's role in the global supply chain remains as critical as ever. So don't fret. Trade is here to stay with or without the US being a big part of the multilateral arrangements that we have thrived upon over the years and decades. All right, so that's the end of my section. Tieying will now take over. Japan, Korea, Taiwan. Tieying, here's the remote. All yours.
Thank you, Temo. So now we move on to Japan, Korea, and Taiwan. Firstly, in Japan, Japan main focus is the new Prime Minister Sanae Takaichi and her new economic policies, the so-called Takaichinomics. On fiscal policy, her policy stance is very clear. She wants to increase Japan's fiscal spending to support consumption, to reduce consumers' living cost pressures. Meanwhile, she also wants to invest more into the strategic industries in Japan, like AI, like semiconductors, to sustain Japan's long-term economic performance. Recently, Takaichi, her government announced the first fiscal stimulus package. A total size was around 21 trillion Japanese yen. That was significantly larger compared to the supplementary budget size in 2023 and 2024, which was around 13 trillion Japanese yen. Well, as we know that Takaichi's party, LDP party, currently does not hold the majority in Japan Parliament. So in order to pass the supplementary budget, in fact, she needs the collaboration from the opposition parties. Opposition parties, they also support fiscal policy expansion, but they propose different measures. The opposition parties, they prefer tax cut measures, including potential consumption tax cuts. So eventually, we may see some kind of debates and compromise between the LDP and opposition parties. In the end, we may see a combined fiscal stimulus package, including both increased fiscal spending and also some degree of tax reductions. What's the impact on the Japan economy? The fiscal stimulus measures will support Japan's consumption, investment, overall GDP growth performance in 2026. On the other hand, however, it will also increase the public debt burdens. If we look at Japan's fiscal indicators, public debt ratio, fiscal deficit ratio, we can see that these ratios, in fact, have improved in recent years. That was partially due to the fiscal reform measures, such as 2 rounds of consumption tax increase, and partially also due to Japan's inflation, which boosted government tax revenues and also boosted nominal GDP growth. However, as the government currently is shifting back to fiscal policy expansion, we may see the improvement trend in public debt ratio, fiscal deficit ratio come to a pause. There may be some rebound in 2026. In terms of monetary policy, Takaichi so far has not directly intervened Bank of Japan's monetary policy independence. Well, she has mentioned that BOJ and government need to have a closer collaboration with each other. However, she is not in a hurry to revise the joint statement between BOJ and the government. On the BOJ side, if we look at the comments from BOJ governor and also the key board members recently, in fact, they sounded hawkish. They are providing signals that the BOJ will continue to normalize monetary policy, to raise interest rates, and this could happen as soon as the upcoming policy meeting in the middle of December. For Bank of Japan, the major indicators they are looking at, one is wage indicator. Wage indicator, as we can see from this chart, wage indicator is currently holding up very well, running at around 2% year-on-year. And this is completely different from 2013 when Abenomics was introduced. Back in 2013, wage growth was in the negative territory. Another indicator is CPI inflation. CPI inflation, we can also see that they are holding up at 3%, already above BOJ's policy target, 2%. And this is also completely different from 2013 when Japan was in deflation. So as wage inflation data both holding up, the positive dynamics between wages and prices is building up. There is the scope and also the need for Bank of Japan to normalize monetary policy, to raise interest rates. With regard to currency policy, Takaichi, her stance so far is relatively unclear. She so far has avoided to make direct comments on the Japanese yen. Whether she favors a stronger yen or Japanese yen, so far the stance is unclear. If we look at the Japanese yen exchange rate, we can see that the yen-dollar exchange rate and also the yen effective exchange rates are both at multi-year lows. The yen currently is undervalued, which is also completely different from 2013 when Abenomics was introduced. At that time, yen was overvalued, so Abenomics was introduced to correct yen's excessive strength. Currently, the yen is undervalued, so there is little justification for the Takaichi government to push for a weaker yen policy. However, although Takaichi is not proactively promoting a weaker yen policy, her existing fiscal policy stance, expanding fiscal policy, has a side effect on the Japanese yen, weakening Japanese yen. Foreign investors are increasingly concerned about the fiscal situation in Japan, so they are selling the Japanese government bonds, which causes the depreciation of Japanese yen. Typically, the dollar-yen exchange rate and the U.S. Treasury Japanese government bond yield differentials, they have a strong positive correlation with each other. When the JGB yield differential with UST narrows, the Japanese financial institutions tend to repatriate their money from overseas market back to Japan's onshore market. So this will drive Japanese yen stronger. However, as we can see from this chart, recently the correlation between dollar-yen exchange rate and UST JGB yield differential has been broken. Although JGB yield differential with UST narrowed, the yen did not strengthen. Instead, the yen weakened further. This is because foreign investors are selling JGBs. Foreign investors selling of JGBs are pushing up JGB yields and also weakening Japanese yen. We now move on to Korea and Taiwan. Korea and Taiwan, the focus is different. The main focus in Korea and Taiwan is about AI. AI-related technology cycle, economic cycle, whether it's sustainable. There have been many discussions about AI and AI-related tech cycle and macro cycle in Korea and Taiwan. If we look at the fundamentals, the trade data, production data, in fact, they show the fundamentals remain strong, remain solid. For example, trade data, Korea just released the November trade data. We can see that semiconductor exports in fact posted a very strong growth, 40% year-on-year, even re-accelerating compared to October and September. And Taiwan semicon exports also posted around 20% growth in October. And in Taiwan, the AI-related exports currently not only reflected in semicon exports, to a larger extent, it's also reflected in Taiwan's ICT exports, information communication products exports, such as AI servers. If we look at Taiwan's ICT exports, the growth is even stronger. It's about 140% year-on-year. Another indicator is semiconductor sector inventory ratio. We can also see the inventory ratio continue to improve in Korea and Taiwan. So the semicon producers, they still need to ramp up output to meet the growing final demand. The semicon cycle in Korea and Taiwan remains expansionary. While the fundamentals remain solid, if we look at the financial market, equity market, there are, however, some clear sense of overheating. As we know that KOSPI, in fact, it's the best performing equity market in Asia this year. It has already rallied 60% year to date, partially due to AI-related optimism, partially also due to Korean government, their push for reforms, corporate governance reforms. So if we calculate the KOSPI market cap as a percentage of GDP, we can see that it has risen very strongly from 80% at the beginning of this year to about 120 or 130% currently. It's a very strong rise during a short time period. For Taiwan, we also see the Taiwan stock market doing very well this year. It has already gained around 20%. And Taiwan stock market cap as a percent of GDP, our calculation shows that it's already hitting 300%, which means the total value of Taiwan listed equities now it's about 3 times of the entire economic size. So from these indicators, we can see that there is a clear sense of overheating in Korean and Taiwan, their equity markets. So the risk of equity market overheating and potential correction, in fact, cannot be underestimated. We also want to mention about the relations with United States, the trade relations between Japan, Korea, Taiwan, and United States. So Japan, Korea, and Taiwan, they have been facing the U.S. Tariff challenges, reciprocal and Section 232 tariff challenges. Japan, Korea, they have already suffered. Although these two countries have already negotiated their tariff rates down to 15%, still this 15% tariff rate has caused contraction, double-digit contraction in Japan, Korea's exports to the U.S. markets. Taiwan, however, is relatively less affected. The major reason is that Taiwan's exports to the U.S. market are dominated by semiconductor and ICT products. And these products currently are still exempted from U.S. tariffs. So that is the reason why Taiwan exports to the U.S. Still doing very well. In fact, still surging very strongly, about 140% year on year. Going forward, however, if U.S. were to introduce a semiconductor tariff, Taiwan will also be negatively affected. If we look at Asian countries, their exposure to U.S. semicon tariffs, the second chart, we can see that Taiwan's exposure is relatively high. Its dependence on semicon exports to the U.S. markets is second highest in Asia and much higher than Japan, Korea. So if U.S. eventually introduce a semicon tariff, Taiwan inevitably will also be negatively affected. In order to bring down the U.S. tariff rates, Japan, Korea, and Taiwan have been negotiating trade deals with the U.S. Japan, Korea have already finalized their trade deals. So to lower the reciprocal tariff rate and also lower the automobile tariff rates, Japan, Korea, they have both committed large amounts of investment to the U.S. Japan has pledged 550 billion investment. Korea has pledged 350 billion investment. When measured as a percentage of GDP, as a percentage of foreign reserves, Korea's investment commitment is relatively significant. That was also partly the reason why the Korean won has been facing the depreciation pressure in recent months. Investors have been concerned that the rise of Korean companies' investment in the U.S., they will cause more capital outflows from Korea and dragging its currency performance. Taiwan currently is still negotiating the trade deal with the U.S. The government is targeting at finalizing the trade deal probably by the end of this year. So Taiwan hopes that the U.S. can lower its reciprocal tariff rate to 15% from 20%. At the same time, also provide some preferential treatment for Taiwan on the semiconductor tariffs. In order to achieve that, Taiwan probably will also pledge a large amount of investment in the U.S. Some news reporting saying that Taiwan may also pledge like 300 billion investment or even more. if the investment figure is so large, there will also be a pressure on Taiwan, especially given that Taiwan economic size, in fact, is smaller compared to Japan, Korea. So if Taiwan also pledges 300 billion investment or even more, there could also be concerns about capital outflows from Taiwan and potentially also dragging its currency or financial market performance. Last, I want to also mention a bit about the relations with China. Japan's relations with China, as we know that the relations is deteriorating recently. Because of Japan Prime Minister Takaichi, her remarks on Taiwan, China has imposed some retaliatory measures. For example, China has restricted its tourists from traveling to Japan. And China has also canceled some cultural and entertainment events in China involving Japanese artists. For the time being, we think the impact on Japan's economy remains small and limited. If we look at Japan's foreign tourist arrivals, currently the primary source is not Chinese tourists. The primary source, in fact, is a Korean and Taiwanese tourists. China's share in Japan's tourist arrival currently is less than 20%. And meanwhile, inbound tourism currently is not the important part of the Japan economy. In fact, the inbound tourism revenue as a percentage of Japan GDP is just around 1%, 2%. So for the time being, we believe that the impact on Japan economy is very small and limited. Going forward, however, if the tensions continue to escalate, if China broaden its restrictive measures beyond tourism and also into the broader services trade, goods trade, or investments, the impact on Japan economy will be much more significant. After all, China remains one of the major trade partners for Japan. And many Japanese companies, they still have operations in China markets. So if China broadens its economic restriction measures, the impact on Japan economy will be bigger. In a more severe scenario, Japan's growth outlook in 2026 will be negatively affected. And the BOJ monetary policy normalization timing of BOJ rate hikes could be delayed. And we may also see some pressure on Japanese yen, on Japanese financial markets in a more severe scenario. So this is all I have. I think I will stop here and also pass the time back to Taimo.
Thank you very much, Tieying. Okay, so we will do some Q&A, and we have the QR code on the screen for our viewers. Either you scan the QR code or dbs.pigeonhole.at, enter the passcode macro25. But before we go, macro November 25, macro NOV 25, okay? I thought earlier I had seen something else. So Tieying, on the China-Japan situation, I sort of hear you that the tourism angle is not that big. It's more headline than substantive as far as the Japanese economy is concerned. But at the same time, when we talk about China-Japan issues, it goes through the cycles of escalation and then over time some de-escalation. What is your read from the Chinese perspective that why such strong response from China this time?
The response, in fact, is mainly because of geopolitics. As I mentioned, it's mainly because of Takaichi, her remarks on Taiwan, which was not very much expected by the Chinese authorities. I think it's very political. But in terms of the economic measures, I think it's not a big surprise. Because in the past, China also imposed some retaliatory measures, economic retaliatory measures during political tensions with Japan, with Korea, or with Taiwan in like 2012, 2016, and 2019 tensions. So economic measures, I think, is not a big surprise.
Exactly. So that's my point, that why react the way China has reacted, given that whether it was Abe or Koizumi in the past, visiting controversial shrines or saying some things which is, seen as inflammatory from the Chinese perspective. This is not a new thing by Japanese leaders. It has been done before. And when we look at what actually happened, PM Takaichi in a parliament, in a very specific hypothetical saying something, it seems to me that it's rather disproportionate, the response. And I'm sort of wondering whether the third party, which is the US, is a factor in this dynamic as well.
That part I'm not very sure, because it's purely about geopolitics. And I think Takaichi, her remarks on Taiwan, in fact, is very special. To China perspective, it's special, different from what Abe mentioned in the past. And that is why China reacted so strongly this time. But it's also interesting that the Chinese public and Chinese society, I think the reaction time is not so severe. Because during the 2012 China-Japan tensions, in fact, if you remember, there was also Chinese consumers boycotting Japanese goods, Japanese cars. But this time, in fact, it's not happening. The Chinese public, in fact, they are still very calm.
But is she seen as particularly conservative from the Chinese perspective, meaning that whether it's defense-related spending or closer ties with the US, although I cannot imagine Japan-US relationship getting any tighter than what it already is. But so is she seen as even more conservative than her predecessors, and that sort of worries the Chinese government?
Probably, yeah, probably.
Yeah. It seems to me, especially, I think, the way her background and her contextualization of issues seems to me that more conservative than any other leader that we've had in recent past. No, it'll be interesting. I'm going to actually Tokyo in March. It'll be interesting to see the vibe. All right, so on Korea and Taiwan, I'm sort of struck by the charts you had showing how, we talk about AI bubble in the US, but those markets have also gone up substantially. So help us appreciate the circularity issues. So one thing that we always talk about is how OpenAI, because it has very low cost of capital, it can borrow money and then promise to invest in chips here or data centers there, and that also boosts the stock price of an Oracle or something like that. Is there similar connections from the chip order supply chain or data center and server order supply chain that the Koreans and the Japanese manufacturers are hugely exposed to the US AI dynamic?
Of course, I think Japan, Korea, Taiwan, their semiconductor supply chain is very exposed to the US ecosystem. So the current ecosystem is, as we know, the US cloud service providers like Google, like Amazon, they are investing massively into data centers. And if you look at the supply chain, when they need GPUs, GPUs are designed by US companies, but they are not made in the US. They are made in Taiwan by TSMC. And it's not only GPUs, it also requires, for example, the HBM, advanced memory chips. And these are made by the Korean companies. So the Taiwan companies, they import HBM chips from Korea into Taiwan. And also they use the GPUs produced by TSMC, and they put into graphic cards. And graphic cards are also assembled into AI servers. And AI servers are finally sold to the US market, to those big US tech companies. And at the same time, there are also many other companies, like those doing cooling system, doing the power system, supporting the entire AI supply chain. So many companies in Taiwan, Korea, Japan, in fact, they are part of the US AI supply chain.
What about the AI supply chain in China? Because of export controls, are the Taiwanese, Koreans, Japanese completely out of it, or they still supply certain parts for the Chinese AI ecosystem?
It's difficult for them to supply now because of the US export control measures. So some customized version of AI chips are still sold to the China market, but it's a low version. It's a low efficient version. And for China, current situation is that it needs to rely on its domestic supply chain to promote the AI development. So China so far has already made some progress in terms of the large language models, in terms of AI chip design, and in terms of AI chips, they are also making some progress. They now are able to produce the 7 nanometer chips, although it's at a low yield and low efficiency. And the bigger advantage for China, in fact, is commercialization of AI, because it has a large domestic consumer market and also a large amount of data used for AI training. So that is a strength of China in AI segments.
But putting GPUs aside, you mentioned the cooling technology, the memory chips that the Koreans make. Are those things available for the Chinese customers?
The HBM chip supply currently also dominated by Korean companies. Yeah, GPU dominated by Taiwan, HBM dominated by Korea. For these key components, China currently does not have so much foreign supply.
Okay.
Yeah.
Right. Very good. All right. Let's look at some of the questions that we have. Question number 1. Biggest risk in global economy in 2026? I would like to say financial market stability, because I think we're sort of done talking about geopolitics and that risk, because that seems to be omnipresent. I don't think anybody would be surprised if we see some more volatility in the US-China relationship or the whole Ukraine, Russia, Europe, US, that entire juggernaut, which one day we make some progress, the next day we don't. So all that stuff I think is pretty well expected. I don't think any sort of risks that is considered as the biggest or most surprising or shocking. On the AI valuation and the disproportionate exposure that the global economy has, and you saw from Tieying's charts that it's not just the US stock market. You can look at the Korean stock market, you can look at the Taiwanese stock market. Similar sort of overvaluation narrative is in place there too. So a correction in that space, a 20-30% correction, could have massive multiplier impact in the entire world economy through chilling of the investment cycle, credit creation, credit spreads, and also the whole negative wealth effect. So we will keep that in mind. And to me, so that issue related to AI, but also, as I was mentioning during my earlier presentation, what happens with the U.S. financial stability framework as the Fed and the SEC and other regulators in the U.S. go increasingly for a lighter touch regulation of the financial system. I think that's quite risky. So they're two slightly different issues, but overall they can be put under the financial stability bucket. Okay, we have one more question. After that, I'm going to have one more question for Tieying. But this question, let's put it on the screen. Your expectation on the new Fed chair and impact on U.S. monetary policy. I think the money is very much on Kevin Hassett to be the next Fed chair. Serious economist, but at the same time has come across as a real sycophant in the past year or so. And if he remains that keen to abide by whatever Mr. Trump wishes, I think we'll have some problems as far as Fed credibility, as far as the risk of financial repression, because the Fed may not get its way and then might have to resort to all sorts of orthodox or heterodox measures to keep a lid on interest rates. So financial dominance, Fed credibility, all of those things might come to the fore as Kevin Hassett takes over as the head of FOMC next year, assuming that is going to be the case. But also, it's not about who's the Fed chair. The Trump administration seems very keen to sway a bunch of members in the FOMC and Board of Governors, so completely remake the balance of power, if you will, with Trump-aligned people as opposed to sort of neutral technocrats to run most important parts of the U.S. economy and the financial sector. So that's worrisome, and to me that remains a major risk. All right, so I will clear that question as well. Coming back to Tieying, the yen. You talked about it on your screen. You showed that how there's this divergence between the traditional relationship between the U.S.-Japan yield and the direction of the yen. Where do you think this goes? Because yen at 156, I don't think the Trump administration is going to be very happy.
Okay, I think, in fact, our view is still for the yen to strengthen versus US dollar in 2026. So the Bank of Japan will expect it to continue to hike interest rates probably as soon as the December policy meeting, which is coming the week after next week. And Fed, as you mentioned, it will continue to cut interest rates. So the rate differential between the two economies will continue to narrow. So Japanese financial institutions, I still believe they will repatriate their funds from overseas market back to Japan. So that will remain supporting factor for the Japanese yen. However, the dollar yen probably may not really return to the level implied by the interest differential. In fact, the level implied by the interest differential is 130, but we don't expect it to return to the level of 130. This considers the fiscal concerns in Japan. As I also mentioned during the presentation, the Takaichi, her fiscal policy expansion is now causing concerns about Japan's fiscal sustainability. So foreign investors, it seems they are losing some confidence about Japan's fiscal situation. So on balance, we think the dollar yen probably will stay at a level around 140 into 2026.
Right, but on the fiscal side, I mean, foreign investors are not that material as far as the JGB holding is concerned. It's largely held by the BOJ these days, whereas in the US, you still have a very large chunk of US treasuries held by foreigners. But even as BOJ considers hiking rates, will this fiscal dominance issue, you know, the thing that exactly I was talking about in the context of the US, and US debt GDP ratio is barely 100%. In Japan, it's over 200%, public sector debt GDP ratio. Could you see a situation where on one hand to deal with inflation, they hike rates, but at the same time to deal with debt sustainability, they do more yield curve targeting at the long end?
Well, I think Japan's debt situation, after all, is still manageable. The good part for Japan is that it's already in an inflation situation. It's not in deflation anymore. So if we look at Japan nominal GDP growth, in fact, it's very strong. It's now rounding at about 4%. So the nominal GDP growth, in fact, is boosting the government tax revenues. And also nominal GDP growth is now higher than the nominal interest rates. So this also makes the fiscal metrics still favorable. So I think the fiscal situation in Japan is still manageable. And as you also mentioned, the foreign investors, their ownership of JGBs is not so high. It's less than 10%. The majority of JGBs is still held by BOJ and held by Japan financial institutions. Japanese financial institutions, they will continue to hold JGBs because of regulatory reasons. And BOJ, I don't think they will introduce yield curve control so extremely, but if the JGB volatility increase, for sure, BOJ can step in. They can increase the quantity of JGB purchases to reduce the volatility in the JGB market.
So Tieying, I personally have concerns because once you have such a big mountain of debt, even like a 10 basis points move, and if there's some volatility around the 10 basis points move, can be quite serious. But you're right, with Japanese financial institutions, and most of them are government adjacent or very government obedient, holding JGBs, it doesn't have to be a debt crisis like the way we saw in the case of the UK, because there it's an open capital account, a lot of foreigners and people taking positions. That is unlikely, but it can still become quite onerous, and there's no free lunch. So they have to maintain strong nominal GDP growth rate. They have to attempt some degree of fiscal consolidation, which doesn't seem guaranteed under Takaichi, and they would have to have interest rates well behaved. So we'll see how between the Minister of Finance and the BOJ, how they manage it next year. Sure. Okay, we have run out of time. So thanks everybody for sending in your questions. This was the last live stream of 2025. So we'd like to wish everybody happy holidays and Tieying, Happy New Year.
Happy New Year.
And we'll see you next year. Until then, everybody, stay safe and stay healthy. Goodbye.